Hi, this is Ron Cipcic. This is the first part of a two-part series on international trade. We're going to be taking a look here at how two countries can improve their outcomes by cooperating with each other. International trade, like trade between individuals, is an attempt by both of the players to improve their outcomes, improve their welfare. So in this case, we have two countries. We have a country called Hillland, and we have a country called Flatland, and those two countries are looking at a product called grain. We'll also be assuming in this model that there's another product being traded, metal, and that will be brought into the analysis later in part 2. Now, we assume that the listener has a basic understanding of market theory and understands how a two-dimensional model in market theory works. So we have our basic supply curve and demand curve for each of the producers, and we notice that both of the producers, Hillland and Flatland, have demand curves. You can see here the demand curves look to be identical. In other words, there's no difference on the demand side of these markets. It's not like one country demands a lot more grain than the other country. We've simplified the analysis by holding the rate of demand constant for both countries, and that's going to simplify our analysis. We also notice that both countries can supply grain, although in Hillland it's very difficult to supply grain. The land is hilly, rocky, it's not very level. It's very difficult to use big equipment, so when you farm in a hilly territory, you're basically going to have to farm by hand. You're not going to be able to use sophisticated pesticides and fertilizers, because when you put those on hilly ground, they'll tend to wash off the ground when it rains and things like that. So we can think of Hillland as a high cost. We can think of it as a high cost, low tech producer of grain. Now, it can be self-sufficient. If it has to make its own grain, it can do that. But what we're going to see later in the analysis is that it can better itself by actually cooperating with Flatland and actually buying Flatland grain. Now, if you come over here to Flatland, you see that the supply curve is way to the right. It's moved way over to the right. And that would be because Flatland is what we would term a low-cost or high-tech producer of grain. So when your cost structure is relatively low and you're able to implement high levels of technology to produce something, the supply curve is going to be pushed way over to the right. And we see that in Flatland, that Flatland has a very high level of supply. Now, the results, of course, are that if you have high supply, your price will be relatively low, and if you have high supply, your production rate will be relatively high. Whereas if your supply is constrained, if it's pushed way over to the left because of high cost and low technology, your price will be relatively high and your production rate will be relatively low. Now, if these two countries are permitted to cooperate, if the government has not erected some sort of barrier, political barrier, legal barrier between these two countries, then we're going to see trade occur. The reason is buyers in Hillland are buying grain at $6 a bushel, whereas in Flatland the grain is selling for $1 a bushel. So the buyers in Hillland are going to notice that they can get grain more cheaply from this other country. And there, of course, will be people engaging in something called arbitrage. Arbitrage is where somebody buys something buys something low and then tries to sell it high. So there will be people who will see that there's a profit opportunity if they can connect buyers in Hillland with sellers in Flatland. So in other words, if I can somehow buy grain cheaply in Flatland and then turn around and bring it over here and sell it for a greater price in Hillland, there might be a profit opportunity. Now, on the other hand, sellers of grain in Flatland, providing again that there are no legal political barriers preventing them from cooperating with buyers in Hillland, sellers in Flatland will be attracted to Hillland buyers. Why? Because at home I can only sell my grain for $1. You can see that here. But if I can somehow get that grain into a foreign market, Hillland, I can sell it for more. So sellers in Flatland will be attracted to buyers in Hillland, and buyers in Hillland will be attracted to sellers in flatland. Remember, buyers are always looking for the lowest possible price, and sellers are always looking for the highest possible price. So there's a profit opportunity, an opportunity for both parties to benefit by cooperating. And again, we have to assume, this is very important, that there are no legal or political considerations that prevent these countries from interacting. Now, let me just choose a different color here. And where would the world price for grain have to fall? Where would the negotiated price for grain have to fall between these two countries? It would have to fall somewhere between 1 and 6. Now let me draw a dotted line across these two models. You can see that I've drawn a dotted line that is below 6 but above 1. Now that has to be the case. In order to get buyers of grain in hill land to be interested in buying grain from another country, the price has to be lower. So let's say the price is $4 for buyers if they buy grain internationally. Okay? On the other hand, to get sellers, so I'll put a little arrow over here indicating that, to get sellers in flatland to export grain, they have to have the opportunity to get a price higher than what they can sell it at home. So for the sake of argument, let's say that this is 2. So flatland is actually going to be the exporter, or international seller of grain, and hill land, I'm going to have to wiggle over here, is going to be the international buyer of grain, and that's the importer. So the importer, again, is an international buyer. Sorry for my cramming that note up in the corner there, but the importer is the international buyer, and the exporter is the international seller. Now let's you may look at these two numbers here, 4 and 2, and you may be confused. You go, well, those are clearly not equal, but they are equal in this analysis. Let me explain. We're assuming here that 2 F dollars, so both of these countries use dollars as their currency, but they're not identical currencies, let's assume. So we're assuming that 2 F dollars equal 4 H dollars. We're assuming that this is the exchange rate. In other words, 1 F, we'll reduce this, 1 F equals 2 H. And that will not change throughout the analysis. We're going to assume that 1 F equals 2 H. You probably know, just from living life in a world where there's globalization and international trade, that different countries use different currencies. And in order to trade goods, you have to first trade currencies. And we'll be talking about that later in our analysis. But for right now, just to keep the analysis simple, we'll assume these exchange rates, that 1F equals 2H. And of course, we can flip it. We can flip it to the other side, and we could say that 1H equals 0.5 F. Or 1/2 F. So 1 H dollar equals 0.5 F. All right? So what this basically says is that 4 H dollars equal 2 F dollars, that these two numbers are actually equal. Now, notice what has happened here. This is very interesting. In the importing nation, the price has fallen. The price has fallen, and notice there's been no shift in the curves, but the price that buyers will be able to pay is below 6. It's actually 4. Now this is going to actually impact the market. What's going to happen is buyers are now going to want to buy more grain where? In hill land. So let's say this is 65. Whereas sellers of grain in hill land, producers of grain in hill land, will not want to produce as much. This is the law of supply. As the price drops, domestic producers of grain will not be able to profitably produce as much. So let's say they don't produce 40 any longer, they produce 15, whereas buyers of grain in hill land want to buy 65 instead of 40. So this is actually a movement away from domestic equilibrium. This model is rather unusual because it shows us moving away from equilibrium, where most models show us moving towards equilibrium. Now the key idea here is to remember that if there's no trade, the domestic price is 6 and the domestic quantity is 40 if there's no trade. But, listen, if there is trade, you have actually two markets coming together and really becoming one market. In the domestic setting, though, in Hillland, the price that Hilllanders will pay is 4. So domestically, you're going to be buying more grain, but you're actually going to be producing less. And this is going to produce what? This is going to produce a shortage of grain. So the importing nation, this is very, very important. The importing nation, let me bubble this so this doesn't get in our way. Let's just bubble this and assume that this is not part of what we're currently talking about. In an importing situation, the importer runs a shortage. In other words, they demand more of the product than they actually produce. And this has to be the case. And you're not going to import if your quantity supplied domestically equals your quantity demanded domestically. You'll be able to satisfy that demand with domestic production. But the idea here is that the price has fallen, motivating buyers at home to want to buy more, but motivating sellers at home to not be able to profitably produce as much, creating this shortage. Now, in the exporting nation, it's just the opposite. In the exporting nation, the price rises and domestic production is going to increase. So this will be our QS over here, and let's say this is 150. Now, higher prices motivate greater production. We know that. That's the law of supply. So we can expect that domestic producers in flatland will want to produce more grain at $2 than they will at $1. However, the higher price will move us up the demand curve, and that will actually cause the quantity demanded to drop. Let's say it drops to 100. So what's happened here is by exporting and the price rising, domestic producers will want to produce more, but domestic buyers will not want to buy as much, and this will create a surplus. So I'm sorry for the clutter here, but the surplus will be the difference between the quantity supplied and the quantity demanded, and that surplus will be 50. And guess what? This shortage over here is 50, so I've worked it out to be even. So the exporter will produce 50 more than it demands, and by doing that, it will have enough to export and meet the deficit or the shortage that's in Hillland. Okay? So we see then that the importer runs a what? The importer runs a shortage and the exporter runs a surplus. And the exporter will produce that surplus and then ship it to the importer who will buy that surplus. And that in the end, the world market will be in equilibrium. In fact, let me go ahead and show that to you. I'm going to have to do a little moving here of my canvas. So let me do that. Please bear with me. I am technologically disabled. So I've got a really cool little piece of software here that I'm still learning to use, and I have to use this little device to move the canvas. Isn't that cool? Okay, now let's think about this a second. Let me get rid of that. Back to our regular writing tool. Let's put both countries together. Okay, so we're going to draw a matrix or a table, and let's go ahead and do that. And this is the quantity supplied. This is the quantity demanded. So this is grain. And we have two countries. We have Hillland, who is the importer, who imports the product. And we have Flatland, who we said will have an incentive to export the product. Now, let's go back. Let me use a different color here. use red for hill land. Hill land produces what? Produces 15 million bushels, let's say, of grain after the interaction begins to take place between hill land and flat land. But now demands at the world price 65 million bushels, running basically a deficit or a shortage equal to 50, right? We've already seen that up here. Here's our shortage of 50. Now, flatland, on the other hand, is going to produce 150 million bushels of grain at the world price, but only demand 100 bushels. So what's going to happen is it's going to run a surplus of 50. I can squeeze that in there. Sorry for that. And notice that that surplus will be exactly what is needed to meet this shortage. Now let me go back to another color here, black. So if you add up total quantity supplied, you have 165 million bushels. If you add up the total quantity demanded, you have 165 million bushels. And lo and behold, the quantity supplied equals the quantity demanded. And the world is in what? The world is in equilibrium. So you have an equilibrium outcome in the world. And that has to be the case. If that were not the case, then the price that we're talking about here, the world price, is not an equilibrium world price, and we would need to recognize that and alter that. And for instance, if the quantity demanded in the world were greater than the quantity supplied, well, the world price would have to rise. If the quantity supplied were greater than the quantity demanded, then the world price would fall. So again, when you have a world market, you're going to have the world price moving towards equilibrium. So let me go back up here. I want to show you something real quickly. Again, we'll go back up to these markets, and let's keep in mind that. Let me get rid of that. Let's keep in mind that 4 is the world price, right? 2 is the world price. The world price will not produce, now this is a very important principle, the world price will not produce equilibrium in each country. This is very important. The world price creates a what? Creates a shortage in the importing nation. The world price creates a what? Creates a surplus in the exporting nation. So the point is, international trade will not produce domestic equilibrium. In fact, just the opposite. World trade will create greater disequilibrium in a market domestically. All right, and that's a huge idea. However, again, the principle is that when you put everything together, when you put, in this case, hill land and flat land together, you're going to see that the world trade, quantity supplied, world demand, quantity demanded, they need to move towards an equilibrium level. And in fact, we have set up a model that does that. Now, I'd like to do one more thing in this particular segment, and that is I'd like to take a quick look at what we call the winners and the losers from trade. So what we're going to show you in this model is that international trade results in a winner and a loser in each country. Now, I'll prove to you in part 2 of this analysis, which is the next video, that the winners win more than the losers lose in each country. So therefore, world trade is good for both countries. World trade is good for both countries. However, we want to acknowledge now that there's a winner and a loser in each country. So let's go ahead and we've done enough analysis that we can see this. So let's draw another matrix, another table, and we'll leave ourselves some room here so we can write some things in here. So on the left column, we'll have winner, and on the right column we'll have losers. And then again we have hillland, who is the what? Who is the importer. And we have flatland, who is the exporter. Okay? Now, let's think about this. Let me use some different colors here. Who wins in the importing nation? Well, that is going to be consumers. The consumer wins. Why? They pay less. They pay less. The price dropped in Hillland from 4 to 2. But they what? The buyers are able to what? Buy more. And that's exactly what happened. The buyers went from buying 40 to buying 65 at a lower price. So the consumers win in the importing nation. Now, who loses in the importing nation? Well, that's going to be the domestic producers of grain. Okay, why? Because they are going to be receiving a lower price, and they're going to what? They're going to be producing less of the product. Okay, so that's terrible for a producer if you're taking less for each bushel sold, and you're actually what? You're actually producing less. This is the law of supply. This is the law of demand operating. So domestic producers that are competing against imported products, they lose in the importing nation. Okay, now let's go to the exporting nation. In the exporting nation, who wins? Well, it's going to be producers of grain. Why? Because their price goes up. We saw the price of grain go up from $1 to $2. And what else happened? We saw them producing what? We saw them producing more. We saw them producing more. So they were able to go from producing 125 million bushels to producing what? Producing 150 million bushels. So they were able to charge more and sell more. Well, that exporters love that. That's heaven. That's heaven to a producer. All right, now who loses though in the exporting nation? Well, you go nobody. Yes, somebody does lose. Consumers. Why? Because they now have to compete against consumers in other parts of the world. So consumers of grain in flatland have to compete against consumers of grain in hillland. And they have to pay more for grain. And in the process, they actually buy less. They go from buying 125 million bushels to only buying 100 million bushels. Now, the interesting thing is, in the trade debate, you never hear from the winners. You know, it's not like people that are benefiting from importation are in the streets protesting. Winners don't protest. So consumers in importing nations and exporters in producers in exporting nations, you're not hearing them protest in the streets. It really wouldn't be protesting. They'd be celebrating. People just go about their business, you know, winning. All right, they're happy and they keep doing it. Where you generally will you'll hear from are the losers. The thing is, you generally do not hear from the losers in the exporting nation. They generally don't know why they're losing. So consumers may be paying more for grain in flatland and not know why they're paying more for grain. They don't realize it's due to exports that are going on now that grain is being exported to another country. So you won't hear from the winners, you won't hear anything from them, and you won't hear generally from the consumers in the exporting nation. Well, who do you hear from? You generally are going to hear from losers in the importing nation. And these are generally going to be workers, so it might be unions that are complaining about imported products, or it might be the executives of companies that are being negatively imported by imports. It might be trade associations that represent industries that are it's often said under attack from imported products or foreign companies. So most of your anti-trade views, sentiments, are going to come from this particular quadrant right here. However, learned people, and I'm assuming as a viewer who is studying international trade, you want to be learned about international trade. There's more to it than just exporters winning and importers losing. And this shows that in each country, whether you're an importer of a product or an exporter of a product, you both win and lose. Now, in part 2 of our series here, we'll show that the winners actually win more than the losers lose, and so international trade is actually better for both parties. So both hill land and flat land will win by specializing and trading along the lines that we've talked about.